Hey, what's up? Welcome back to Dapper Dividends. I am your host, Russ, and this is the start of Sober October. My wife and I are going a full 30 days with no alcohol, and we're going to end it on my favorite holiday of the year, which is Halloween. Ever since I was a kid, I've just loved this time of year. I love going trick-or-treating, the costumes, the leaves on the ground. You got that really cool, crisp air coming in here in the upper Midwest. My favorite time of year. So that's what we're doing. We went apple picking yesterday, spending time with the family, with the kids. This is what life is about for me. But whatever it's about for you, life is short, so make sure you are doing what you want to do and what makes you happy. But just don't enjoy life too much, because I was reflecting and thinking back how I came up from a lower middle class background, grew up in Berwyn, Illinois, which is just outside of Chicago. I went to the Navy for more opportunity. I wanted to get away and see something different. That I did. It opened up doors. I saw, by the time I was 21, I saw all 24 time zones, the equator, both hemispheres, the tropics of Capricorn and Cancer, and 4 continents by the time I was 20. So I definitely saw a lot of things. I got a lot of experience and opportunity. It opened doors for me into the trades, what I've been doing now for the past 20 plus years. I've been doing welding. I've been repairing dock and door equipment. That's what I do. That's what pays the bills around here. And it wasn't until a few years ago that I really realized that having one stream of income, having that single stream of income, is super risky. Yes, I'm putting away for retirement in my IRA, but that's down the line, and so many things can happen between now and then. And plus, I was only putting away the minimum at times, which I would strongly suggest doing whatever you can do to max out your retirement account. It is so beneficial, especially if you get that employer match. That's free money. Don't give away, don't turn down that free money. But having only one stream of income, super risky. The way I like to think of it, as if you were a business owner or running a business and you had one customer that was responsible for 100% of your company's revenue, I don't think you would be okay with that, because if that customer left, that means you have no more revenue. They also say it's like having one fishing pole in one pond. Well, why not have 10 fishing poles in one pond, or better yet, 10 fishing poles in 10 different ponds? That's what I'm doing. I actually have a book that's coming back this week from the editor, and I'm going to have it put into ebook form, so that should be ready to be sold. That's a thing I'm doing. I've always wanted to have a book, so I just did it. I don't know if anyone's going to buy it, but damn it, I'm doing it. But back to the streams of income. The easiest way that I have found is dividend investing, dividend growth investing, buying world-class companies that everyone needs. Procter & Gamble has been paying a dividend for almost 130 years. People need companies like Procter & Gamble. You're buying companies that are going to give you a portion of their income, and it is buying a company. When you buy a stock, you are buying a small portion, a teeny tiny portion of that company, and they're returning a portion of the profits every 90 days to you. That is a second stream of income that quick, that easy. Now with dividend growth investing, it does take a while to build that up, but you are getting money. That is a second stream of income. It is easy as tea. That's not advice to buy AT&T, ticker symbol T. It's one of my favorites, and it's one of the easiest blue chip companies that you're buying, not for growth, but for their massive dividend income, as buying one share of that company, and every 90 days they pay you cash money. That is a second income stream you can create just like that. That is the easiest and lowest barrier to entry I know of, is dividend growth stocks. Reinvest that money constantly and consistently, dollar cost average in, so you're buying more shares when the price is low and you're buying less shares when the price is high. Do it. Get in the habit. The habit is more important than the money. And just do it. Just start today. No matter what you have to do, start. The timing is never right to do anything. Just get started. Let's go. I'm going to tell you what's been going on in my taxable account, in the IRA, and stash, worthy bonds, and Acorns. I'm going to hit all three of those. But first, I'm going to start with the stock of the week, and here it is. Eaton Vance in the financial industry. They have investing and wealth management solutions, and they are financial advisors to high net worth individuals and institutional investors. They can trace their roots back to March 29th, 1924. On FinViz, you can see that the financial industry over the last year has been pretty well beaten down. Second to the bottom, only outpaced massively by the energy sector. Year-to-date relative performance, negative 21%, so there's a lot of room to come up. On the daily chart, they have bounced up off of the $35 range. You can see they have a lot of support around the $35 range as of late. And if you want to jump into this for a trade, I see there might be room to run up to about $42. So a few more dollars is in the cards, I believe, that it can run up. Currently trading at $39.36. On Yahoo, they primarily have a strong hold recommendation with an average price target of $43.31, so it is undervalued according to the Yahoo. The dividend is 38 cents a quarter, which is $1.50 a year. It's a nice, healthy 3.81% yield, only 37.65% of cash flow, and they have been increasing that dividend for 25 years. On Y charts, we see that the PE is 15.68. and it has a 5-year average of 16.69, so it is slightly undervalued based on the metric of PE against itself. Charles Schwab gives Eaton Vance an A rating, a percentile ranking of 9, which is strongly outperformed, which is a buy. Very healthy net margin, 22% compared to the S&P at only 7.5%. If you remember net margin, you look at that is how much of $100 does Eaton Vance get to keep? That comes in, it's $22.20 is what that metric tells us. This is from August 25th. Morningstar gave them a fair value estimate of $37. So based on Morningstar, it is a little bit overvalued, but they do give it a 3-star rating. CFRA also gives Eaton Vance a 4-star buy rating with a 12-month price target of $44. This is from September 26, so this is a little bit more recent. Very nice 31% return on equity over the last 5 years. The free cash flow over the last several years has been pretty consistent, a little bit choppy, up and down, but the last 2 years it has steadily increased. Of asset managers, they are the 3rd largest below Invesco and Owl Rock Capital Corporation. And last, the Reuters report. Quick chart, I wanted to point out that sales has slightly decreased, but income has been going up, earnings per share going up, and the dividends per share has been going up very nicely. 3-year average of the net profit margin, a very healthy and stout 22.88%. Return on equity, a very nice 35%. Current payout ratio, according to Reuters, is 38.52%. And as we can see, the payout ratio has not really gone over 44% over the last 3 years. Reuters does have a consensus recommendation of hold, as you can see right there. And the earnings per share, they do expect obviously to dip from last October to this October, but a lot of growth, a lot of room to run up for next October. That is Eaton Vance. Put them on your watch list. Take a look at them. Not investment to buy them. What I do like about Eaton Vance is there are many baby boomers that are retiring and going to need help managing their money. But what I don't like, the bad, is that there are lots of ETFs, with the popularity coming from ETFs and the whole do-it-yourself thing. I do think that Eaton Vance is going to have to stay competitive and attractive to make people feel that they cannot do a better job by themselves. Eaton Vance, you might not be aware of them. Take a look. I'm not saying to buy them, but I am saying to be aware, put them on your radar, do your due diligence. If you're looking for a new idea, there it is. You've got a new idea. So now we're going to check out the few things I bought in my taxable and my self-directed IRAs right now. Okay, to Dapper Dividends we go. And what I did receive in income this week was $11.25 from Pepsi and the fantastic Albemarle, ticker symbol ALB. They are the lithium producer. They're the ones that are going to be moving all these lithium-run batteries in the EVs. And the buys this week, 1 share of Pepsi at $138.50, $4 it gave me. Did you know that Pepsi was the first company, the first soft drink company in the 1970s to start using 2-liter bottles? Come on, you didn't know that. I didn't know that, so you didn't know that. And if you did, congratulations. One share of ExxonMobil at $32.39 for an insane 10.74% yield gives me $3.48 a year. So just 2 shares this week. It's okay. You don't have to go balls to the walls every single week. I only bought 2 shares, and as I tweeted out and put in my podcast, I think that ExxonMobil and the oil sector is way beaten down, and it's going to be capitulating soon, I think. But when the best thing for low prices is low prices, because supply will tamp down and burn off, and it'll be coming back into balance. We'll see the big companies like Exxon and Chevron that are not just sell and drill. They are diversified. They're upstream, midstream, and downstream. They do it all. They're going to be able to withstand these headwinds in the oil sector. So the income breakdown, $1,500 a year. Not much, just ticked up from last week. But you know what? It moved up, and that's all that matters. SDIRA, hello, I can read. Genuine Parts Company, ticker symbol not FRT. Boy, I got to change that. GPC gave me $3.95. My buys of the week had FRT on the brain. I bought 2 shares of Chevron at $69.74, which yields an amazing 7.40%. Gives me $10 of annual added income. Federal Realty Trust, 2 shares at $73.16. Look at that yield, 5.80%. $18.80 this week. I did get, again with Chevron, I believe that their share price is higher than Exxon, and it's reflected that they have a stronger balance sheet, and I would say of the two, they are more or less likely to cut or suspend the dividend. Just ticked up, same thing with these, a little bit, $1,200 a year, giving me more money to buy stocks, so you can start out small. It takes a while, just dollar cost that money in, dollar cost average in, and as always, I'm going to give myself 5 stars. Thank you. Next up is going to be the Stash Worthy Bonds and Acorns segment that I call Stashing Worthy Acorns. Those of you that have been around the channel for a while, this used to have its own segment, and this was the impetus of the entire channel. But as you're watching, I'm learning, I'm growing, I'm evolving, I'm improving. I'm always seeking to improve. That's what I'm doing. So let's get into the Stash Worthy Bonds and Acorns part, and I'm going to lead off with a nice little video animation, which you can see in the comments below. I have an affiliate link. If you want to make videos like I do, just 3 clicks. Videos, I have the affiliate link, gives you a special discount. Check it out, see if they're right for you, and have some fun if you want to make video animations like I do. Let's get into it and what I bought this week. And Stash, you can see that I did buy Procter & Gamble this week. It was 39 cents lower than Johnson & Johnson. And the way I'm doing that is whichever of the 3 is the lowest when I get my $5 into the account, that's who I'm buying. And it looks like I may be putting money into J&J this week, depending on how things shake out with Apple. So I've made over $40.72. That's a 20% gain on my money. This is so simple and easy. Brainless, $5 a week. Lowest of the 3 gets the $5. That's how we do it. Almost $240 already in Stash. If you didn't check it out, I did a video on what worthy bonds are, and as you can see here with this nice little pop-up, they have $50 million in bonds that's sold out of Worthy Pure Capital 2, and Worthy Community Bonds is the next entity that is available and ready to be bought. And in Worthy Pure Capital 1, I have $1.42 of interest earned for $51.42. I have 5 bonds. I got in on the tail end of that, and I won't be able to put any more money in, so it is going to keep compounding very slowly, but irregardless, it is still 5% compounded every single day. And Worthy Pure Capital 2, I am going to be stuck at the 14 bonds because I can't buy any more, so I will be setting up the Worthy Community Bonds segment. I'll do that later. This is now at $142.19, earning almost 2 cents of interest per day, compounding every single day. Those bonds are pending transfers, so they have not hit the account just yet. And the big money account, look at the confetti. I love it. $116 of interest already earned. As you can see, the more money you have in, the more that the compounding takes effect. We will not be able to buy any more bonds in this either. I have put in 7,230, 7,346, 66. Officially at $1.02 a day. And you can see the more money you have, the more quickly it compounds, the faster that wealth snowball grows. Well, good afternoon to you too, Acorns. $230.42 is what I have in. As always, the portfolio is set on aggressive $5 going in every single Wednesday. I've had a total gain of $23.42, just like that easy. And when you scroll down, you can see 3 different iterations of how you can view your performance, either by the dollar amount, percentage amount, or the share amount, which I only have 1 share of the IXUS ETF. These are all ETFs, and the biggest one here, if you click on them, it's the VOO. If it was up to me and I wasn't doing this, I would just put the money into VOO myself through Schwab or Robinhood or Webull, and I would skip Acorns quite honestly. And in the last 30 days, check it out, I've gotten 67 cents of dividends. The bar chart, we started everything off at $50. Everything's just been up and to the right. Now, Worthy Bonds is going to get a boost here of $20, so it's going to be a little bit higher. Not as quite high as Stash and Acorns, but as I love it, everything just up and to the right. Stash did peter out here for just a bit, but now we've been picking back up. You can't predict the market. This is why don't ever try to time the market. We don't know what is going to happen over the long term, though. We do know that things are going to go up and to the right. If you got value from me today and you like what I did and you want to see more, give me a like, subscribe, leave me a comment, let me know what you did or didn't like, what dividend stocks you have, or you can hit me up on Twitter at RustyRam78. I also do a podcast that I'm doing every Tuesday and Friday. I know it's a lot. And I also have a website, dapperdividends.com, where you can see my dividend weekly recap. And as always, the disclaimer, we're going to wrap it up with that. I am not a licensed financial advisor, and this is not financial advice. I am a very humble Dapper Dividends podcast and YouTube channel host, sharing my thoughts and opinions for fun and entertainment only. If you're going to put any money into the stock market or any financial instrument, you need to do your own due diligence first and speak with a fiduciary licensed financial advisor. I look forward to speaking with you next week. Peace.